Imagine a life where your bills are paid before you even step out of bed. No, this isn't about winning the lottery. It's about a systematic approach to investing known as the Monthly Dividend Strategy. For most investors, dividends come once every 3 months. But for those who crave stability, there's a better way. A way to align your income with the rhythm of your life. In this 10-minute comprehensive guide, we are going to pull back the curtain on the big 3 sectors that pay monthly and show you exactly how to build your own income machine. First, let's look at the math. Most household names like Apple or Coca-Cola pay quarterly. While that's great for long-term growth, it creates income lumpiness. Your rent is due every month. Your car payment is due every month. Your grocery bill, definitely every month. Quarterly dividends just don't match that cycle. Monthly dividends solve this. They provide a smooth, predictable flow of cash that covers your overhead, allowing you to breathe easier and plan better. But there's a secret weapon here: compounding frequency. When you reinvest dividends 12 times a year instead of 4, your interest on interest builds faster. Over 20 or 30 years, that small monthly edge can snowball into a significantly larger portfolio. It's the difference between a steady walk and a light jog toward retirement. Now, let's dive into our first pillar: REITs, or real estate investment trusts. These are the backbone of most monthly income portfolios. REITs are special companies that own income-producing real estate. To avoid double taxation, they are legally required to pay out 90% of their earnings to you. The gold standard is Realty Income, known literally as the Monthly Dividend Company. They own thousands of properties leased to reliable tenants like 7-Eleven and Walgreens. They've increased their dividend over 100 times since 1994. It's the definition of set-it-and-forget-it income for a beginner. Then there's STAG Industrial. They focus on warehouses that power the e-commerce world. As long as people keep shopping online, STAG keeps collecting rent and paying you. Next, we have the middle market masters, business development companies, or BDCs. These act like mini banks for private businesses. They lend money to companies that are too big for a local bank but too small for Wall Street's bond market. In exchange, they get high interest rates and equity stakes. Because BDCs are structured similarly to REITs, they also pay out the vast majority of their profits as dividends, often leading to yields of 8 to 12%. Main Street Capital, or ticker MAIN, is the premier choice here. They have a history of paying monthly dividends plus special bonus dividends when the economy is strong. However, be warned, BDCs are sensitive to the economy. If interest rates shift or small businesses struggle, these stocks can be more volatile than traditional REITs. Our third pillar is the simplest for beginners: monthly dividend ETFs. These give you a whole basket of income-producing assets in a single click. A popular choice lately is JEPQ. It uses a covered call strategy on the NASDAQ 100. It's complex under the hood, but for you, it just means a massive monthly check. JEPQ often yields over 10%. But remember, you're trading away some of the moonshot growth of tech stocks in exchange for that immediate cash flow. If you want something safer, look at the Wisdom Tree US Large Cap Dividend Fund, ticker DLN. It holds stable giants like Microsoft and Exxon, but pays out every month. Now, here is something most YouTubers won't tell you: taxes. Not all dividends are created equal in the eyes of the government. Qualified dividends from normal companies are taxed at a lower rate, but REIT and BDC dividends are often taxed as ordinary income, the same as your salary. This means if you're not careful, a big chunk of your monthly check could go straight to Uncle Sam. This brings us to a critical strategy. Hold your monthly dividend stocks in a Roth IRA. Inside this account, your dividends grow and can be withdrawn completely tax-free. It's the ultimate loophole for income investors. Before you jump in, we need to talk about the yield trap. This is the #1 way beginners blow up their accounts. You see a stock paying 15 or 20% and think it's a bargain. But ask yourself, why is the yield so high? Usually, it's because the stock price has collapsed. This is called NAV erosion. Some high-yield funds pay you using your own principal. You get a check for $10, but your investment value drops by 15. That's a losing game. Always check the payout ratio. If a company earns $1 but pays out $1.20, that dividend is a ticking time bomb. It will be cut eventually. Let's get practical. How would you build a balanced $1,000 monthly dividend portfolio today? Here is a simple, diversified blueprint. Put $400 into high-quality REITs like Realty Income and STAG Industrial. This gives you a rock-solid foundation in physical real estate. Next, put $300 into a top-tier BDC like Main Street Capital. This boosts your overall yield while supporting American mid-sized businesses. Finally, put the remaining $300 into a monthly ETF for diversification. This ensures you aren't overexposed to any single company's failure. With this setup, you might start with $5 to $7 a month in pure passive income. It sounds small, but remember, this is just the beginning. As you add more money and dividends are reinvested, that $7 becomes $70, then $700. Eventually, it replaces your paycheck entirely. The biggest obstacle isn't the market, it's your own patience. Most people quit when they only see a few dollars of income in the first few months. Wealth is built in the boring middle. It's the monthly discipline of buying more shares even when the market is red and the news is scary. To make your monthly income even safer, look for dividend aristocrats. These are elite companies that have increased their dividends for at least 25 consecutive years. When a company has a track record of paying through recessions, crashes, and global uncertainty, you can sleep soundly knowing your monthly check is likely to arrive. Don't let high stock prices stop you. Most modern brokers allow fractional shares. You don't need $500 to buy one share. You can start with just 5. This is a game changer for beginners. It means every single dollar you invest starts earning dividends immediately, regardless of how small the amount is. Once or twice a year, you should rebalance your portfolio. This means selling a bit of what has grown too large and buying more of what is currently undervalued. This keeps your risk in check. If REITs have a massive run, you lock in some profits and move that money into BDCs or ETFs that might be offering a better value. Don't forget the world outside the US. There are international monthly payers that can provide global diversification and exposure to different economies. Adding international exposure helps protect you if the US market enters a flat period, ensuring your monthly income machine stays powered by global growth. To recap, use REITs for stability, BDCs for yield, and ETFs for diversification. Keep them in a Roth IRA to maximize your gains. Avoid the traps. Don't chase 20% yields if the company is bleeding cash. Sustainability is your best friend on this journey. Now close your eyes and imagine yourself 10 years from today. If you start this strategy now and stay consistent, that monthly check won't just cover your coffee. It could cover your mortgage. That is the true power of this strategy. It's not about getting rich overnight. It's about buying back your time, 1 month and 1 dividend at a time. Financial freedom doesn't happen by accident. It happens by choice. The choice to start today, no matter how small your first investment is. Your future self will thank you for the checks you started receiving today. Take that first step, stay the course, and let the compounding begin. If you found value in this guide, subscribe for more deep dives into the strategies that actually work. We'll see you in the next one.